going to jump right back into it, and I'm very excited to invite my next guest to the stage, because if you've been coming to this show for 18 years, then you were here when his company was a startup, and today it's a $4 billion company. So I'm very excited to welcome the CEO of Uranium Energy Corp, Amir Adnani. Come on up, Amir. All right, whatever you like. All right, so Amir, it's good to see you back on this stage again. You're very far away from me, but this is
but I can hear you fine. Good to see you.
Good to see you. All right, so I'm excited to have you back because as I just mentioned to the audience, 18 years ago, you were in this trade show with a startup. Today, that startup is worth $4 billion. This year, you've made a ton of money for your shareholders. I think you're up 4x thus far this year. Last week, you put out some news that convinces me you've just materially maybe changed the value of the company. We're going to talk about that in a second. We just hosted the Uranium Outlook panel, right? Talking macro, forecast. How would you break down the sector right now? You've been in it a long time, mainly tough years. Now we've got some good ones. What's catching your eye, uranium macro fundamentals right now?
Yeah, I was sort of listening bits and pieces of the panel that you just had. And I mean, for context, for everyone's benefit, I might be the wrong guy to ask about how to play the current, red hot uranium market, because I'm an entrepreneur. I've been at the idea of building uranium energy from a business plan to what it is for 18 years. For the last 18 years, I've never sold a single share. So I'm fundamentally, you could argue, biased. So that aside, but I think at the end of the day, we have, there's a physical problem in uranium right now. The warehouses are empty, and uranium is consumed annually. It's burned up. It's used as a fuel to generate electricity. So it's a depleting commodity or asset. It doesn't have any other application other than to be used in a nuclear reactor. So I think the reality is, if we want to talk about charts, and if we want to talk about how things are behaving from that point of view, that's one thing. But if we want to fundamentally ask ourselves, what's going on in the market fundamentally, the warehouses, particularly in the West, are empty. And Kazakhstan, which is a single nation OPEC, 40% of global supply, 40%, announced last month that nearly 90% of their exports went to either China or Russia. So not only are the warehouses empty, the warehouses in the Western world are empty. It used to be that people would say uranium is fungible. Doesn't matter if you bought uranium in Russia or Kazakhstan or Canada or US. Today it matters. Today, when we see day-to-day trades in the uranium market, in the spot market, the most sought after location for settlement is the US. And that's the hardest place to find material in. So right now the uranium price is $106 a pound. But that's $106 a pound if you're willing to take uranium at a location in France. There is no offer. No one has uranium for sale right now at 106 or 107 if you needed it in the US. So location matters. These specific things matter. And if we want to talk about charts, let's talk about charts. The uranium price for the last 11 years was flat. The uranium price for the last 11 years, as $20 a pound average, was below the marginal cost of production. We've been in a bear market for 11 years. We now have a positive market in the last 90 days. But more importantly, I would argue, based on facts, that we've been in a bear market since the early 1990s. We've been in a bear market since the Cold War ended. Because when the Cold War ended, we started to de-stockpile the Russian-Soviet era Union warheads. And that was the equivalence of the world's largest uranium mine. So we spent 13 years de-stockpiling Russian material since the end of the Cold War. And then the Japanese accident, Fukushima in 2011, meant we just spent another 11 years de-stockpiling Japanese inventories. The market has been in de-stockpiling mode for 30 years. And mine development, new mine development, has been really limited to just a couple of companies, Cameco and Kazatomprom.
Yeah. And would you factor that mainly towards sentiment? What's with the restrictions on new projects coming on board? I mean, sentiment shifted massively. You've been in this game 18 years. Sentiment has transformed. What's the driving force behind the demand? Because we talked a lot about the limited supply on the previous panel. What's driving the demand right now, Amir?
It feels like we woke up one day, right? And we came to the conclusion globally at the same time that we can't achieve net zero, we can't decarbonize while meeting this growing energy needs globally without nuclear power. There isn't a single climate scientist on the planet that has looked at modeling how you decarbonize while meeting energy needs and conclude we need nuclear power. So that's why the policy shifted significantly. The policy shifted, governments got on board, public sentiment changed. Russia's invasion of Ukraine drove energy prices up in countries like Japan. Japan's public opinion forum in favor of nuclear energy became the best since Fukushima happened last year. In the US, the public opinion polls in favor of nuclear energy are at an all-time high. It used to be that if we were in the nuclear business, which we are, we used to think we needed a Republican in the White House to get favorable policy. We've seen the best policy in the US with a Democrat in the White House, with President Biden. There's bipartisan support. There's incredible appetite from governments to allocate capital to see new nuclear reactors, extend the life of existing reactors. And that's why the business has grown fundamentally on the demand side into a big positive. Now here's the interesting thing. In the US, they're talking about extending the life of existing reactors from 50 years to 70 years to 80 years. So with a signature, right? With a signature, you extend the life of a reactor by 20 years. Can I extend the life of a mine with a signature? A mine is depleting. A mine has a finite mine life. And so the supply demand is also facing this issue where demand is so strong and being extended out, but the mines have been ignored and underinvested, and our section has been undercapitalized for, I would argue, 30 plus years.
Now, you recently just inked a deal or a partnership with Bill Gates to supply his small modular reactors with uranium. Could you walk me through the details of that deal and, in tandem with that, why we're seeing so many personalities like Gates, like Musk, like Sam Altman turn their attention towards the nuclear sector?
Yeah, it's phenomenal. I mean, to think that we were a startup 18 years ago, as you pointed out, and here we are transacting and doing business with Bill Gates, and then Bill Gates is in the nuclear business. And the Canucks are the top of the league in the NHL. Like, what? It's just, as a Vancouverite, what a time to be alive. And the end of the Trudeau administration is around the corner. So we've got a lot of great things going on all at the same time. But I bet you no one in this room can guess what is one of the biggest drivers of nuclear energy and demand for nuclear energy as a new industry out there. No, demand. Artificial intelligence. Artificial intelligence, MIT, look up the study. MIT just came out with a study that shows one image generated by AI consumes the same amount of energy as you recharging your phone for one reload. Think about that. So why is it that Bill Gates and Sam Altman and Elon Musk and companies like Amazon and Google are talking about nuclear energy? Because they're looking at the demand and consumption of energy and power they need to power new data centers that's going to power their AI dreams. They're going to the public power utilities and they're saying, hey, I need this much more power over the coming years. And the utility companies are saying, I can't keep up.
Have you thought about doing something with Zuckerberg?
All right, we'll get to that. We'll get into that. But look, this is key. The key is that we've got this step change in demand for power. And that's why SMR companies, small modular reactors and advanced reactors, are being built so they can co-locate next to a data center and power that data center that the grid can't supply energy to. And this is why Microsoft has announced their plans to buy and install SMRs. That's why Amazon, Google, Walmart, any company that wants to automate and has a plan around artificial intelligence needs to think about how to power that. And we haven't seen this kind of step change in power consumption in the West in over 100 years. And then that's where nuclear comes in, on top of all the favorable policy that says if we're going to decarbonize, we need nuclear. In order not to meet even this growing energy demand, and the guys driving it are Silicon Valley billionaires. Yeah, look, I'm proud of this. We signed an agreement to provide uranium to Bill Gates' company, TerraPower, that's going to build a small modular reactor in the state of Wyoming, where we're also restarting our uranium mine called Christensen Ranch.
Yeah, you just announced that last week, restarting production in Wyoming. So walk me through the future, next couple of years of Uranium Energy Corp, Amir. What are you looking forward to the most?
Look, one thing that we're excited about is the fact that we're announcing our production restart at a time where uranium is $106 a pound, and our production is 100% unhedged. The long-term price, the price for contracting, if you had signed a contract a few years ago, is $70 a pound right now. As a shareholder, put your hand up. Would you like me to be selling uranium at $70 a pound or $106 a pound?
Amir, would you mind walking the audience through the concept of hedging and why uranium companies have done it in the past and what it means to future cash flow? It's, I think, important to break down.
Hedging is a concept in the uranium market that goes back to the fact that for the longest time, the uranium industry was quite a controlled market by a number of government-owned companies that mined all the uranium in the world. And those government-based companies, Cameco used to be a crown corporation. Orano is a government company of France. Kazatomprom is 90% owned by the government of Kazakhstan. These large producers that control the uranium supply are run by individuals that are hired guns. They're not thinking about driving value of shares or share price for shareholders. And so they were happy to sign long-term contracts, and utilities are happy to sign long-term contracts because everyone has the certainty that they get their uranium at a certain time, at a certain price, at a certain location. We came into the picture, and a lot of entrepreneurial companies came into the equation saying, but in the iron ore market, and the gold market, and the copper market, it doesn't work like that. You sell based on spot, and you get that price. And the market has started to really shift and really evolve in the uranium sector, so much so that companies like ours that have said, we're going to stay unhedged, now benefit from having no ceilings on the price we can realize. There's no fixed pricing in our business. If we had fixed the price at 70 because we thought that was the top, we'd be leaving a lot of money on the table right now, but we haven't. And we have a uranium price today that's at $106 a pound. On an inflation-adjusted basis, that price can go to $200 a pound. If you take the price from 2007, which was $140, and you adjust that for inflation, that price today is $200. And I think you would all agree the fundamentals today are significantly better than they were in 2007. And in 2007, Russia was a reliable supplier of uranium to the world. Today, we're going towards a bifurcated market. Western companies and Western customers and utilities need uranium from Western sources. So look, I think for us, we're most excited about the fact that we're unhedged in this new bull market for uranium. We're excited about the fact that our projects in the US are permitted. Because what's the knock on Western development? It takes a long time to get permits. We have the permits, we have the infrastructure, we're restarting production, and we're restarting mines that were in production already. So this is a restart. It takes a lot of risk out of the equation. And finally, in this bifurcated market for uranium, we're excited about some political catalyst. Right now in the Senate, in the US Senate, there is a bill called the Ban Russian Uranium Bill. Doesn't get any more specific than that in terms of what it intends to do, right? And that is a major catalyst in the coming weeks if that bill is signed into law. And you won't believe who's getting in the way of it. Senator Ted Cruz from Texas, which is where my company is based out of. Ted Cruz is holding this bill up because he wants to trade some stuff on another bill that he's sponsoring. But if that happens, the US, which is the largest consumer of uranium in the world, where the government of the United States has set up a strategic reserve to buy uranium for the government account. The last time the US government was buying uranium for the government account was the 1950s. Think about that. This is not an every decade thing. It's quite rare. And uranium, it really does matter where it comes from and what the location is. The US government can only buy US mined uranium. And look, we've got a lot of, as my company's got a lot of projects in Canada, but our Canadian production won't qualify for selling to the US government. Only our US production will. And so there will be a US price. And that's no different, by the way, than the oil market, where there's a price for Brent, there's a price for WTI, there's a price if you're willing to pay cash and buy oil from the Iranians who are sanctioned, and you take a tanker from them in the middle of the Persian Gulf, right? So there's a differential in the price. Not all pounds are going to be created equal anymore. So I'm excited about that. I'm excited about the fact that we have a company today at UEC that can produce uranium from US sources, that can grow future production with Canadian assets, all makes up a portfolio of Western reliable supply. We're unhedged, and most importantly, we're debt-free. And look, uranium companies in the last 20 years haven't had to deal with a high interest rate environment. We haven't had to deal with inflationary pressures. This is a difficult environment to be building uranium mines. And we're hedged from that because our projects are built already and they're restarts.
Now, given that bifurcation, do you put much weight at all on Kazatomprom making this announcement that they're likely going to miss guidance? Because it's taken the uranium world by storm and everybody's talking about it and how significant it may or may not be. You know, they contribute 40% to the world's uranium, but as you just shared, 90% of that just goes to China and Russia anyways. It would never enter the Western market. As an American producer, do you put any weight? Like, how much do you weigh that? And then secondly, they announced they may likely miss guidance. How would you interpret that? Is that the tip of a much larger iceberg that's largely going to be uncovered? What are your thoughts?
Well, look, if this was the oil market, right? In the oil market, if Saudi Arabia or the OPEC, if they sneeze, right, the rest of the world catches pneumonia. In the uranium market, Kazatomprom just sneezed, and Kazatomprom is a single nation OPEC. 40% of global production, half of which is owned by Russia, by Russia's nuclear energy company, Rosatom. So the Kazakhs don't own all that production. The Russians own half of it, the Chinese own some. And so I think the fact that Kazatomprom does have sulfuric acid issues in terms of availability of supply chains that they're having problems with, that they're talking about, the fact that, again, their production arguably is spoken for because it's a landlocked country, and that supply has a much easier time going to China and Russia than being shipped to Charlotte, North Carolina. The reality is, I think the February coming news of Kazatomprom could obviously give us a lot more detail, but the fact that they wanted to get ahead of that news and say, look, we're having problems, I think speaks to the fact that the world's biggest producer has just sneezed. In fact, I don't think the uranium price has really moved. If this was OPEC or Saudi announcing something like this, uranium price would be up 30, 40%, the oil price. And so by analogy, I think the uranium price does move slower. But look, I think at the end of the day, you guys in this room, in this hall, and your conferences, Jay, over the years, you don't appreciate how close to the action you are. You're very close to the uranium action. I spoke last week at an energy conference to energy institutional investors, and not a single energy-focused institutional investor last week that I spoke to has exposure to the uranium sector. Zero. This has been a niche sector for the longest time. This is a sector today that on a collective combined market cap basis is still smaller than Spotify. It's still smaller than so many technology companies. This is an under-owned sector. And what amazes me is how at conferences like this, the knowledge level is actually so much higher than Wall Street, than the larger energy-focused institutional investors.
I never would have guessed that at a conference like that exposure would have been...
I was surprised as well.
Would have been so low. So I know you said, and I know that you don't worry about volatility in the price because, well, the proof's in the pudding, man. You've been dedicated to your company for 18 years. Now you're reaping some rewards. But what would you say to investors who are curious about the longevity of this market right now? And it's gotten pretty hot, pretty quick, but all of a sudden, right? There's a lot of fundamentals that support legs. But what would you have to say to shareholders right now who are wondering if it's time to step back or wait for a dip?
Let's talk about facts, and let's not talk about charts and things like that. Here's a fact. I think if there's one thing you're going to take away from this last 30 minutes, it should be the following, okay? According to the Nuclear Energy Institute in Washington, D.C., that tracks the expense for all nuclear utilities in the United States, the cost for nuclear fuel in a nuclear reactor to keep that reactor running, the cost of the fuel is 5.4%. That's nuclear fuel. Uranium is 1/3 of that. So the uranium price is nearly and only 2% of the overall cost of power generation. It's nothing. That means we have price inelasticity. Unlike natural gas, in a gas-fired power plant, gas prices are 70% or more of the cost of power generation. And the Inflation Reduction Act, IRA, in the US provided billions of dollars of support and credit to nuclear utilities. So I think the key takeaway is the end user for uranium today in 2024 is in the best financial shape it has ever been in. These guys are licensed to print money. And uranium at $106 a pound is 2% of their operating costs. And I think that's the biggest takeaway. And if the warehouses are empty and there's a supply deficit, which out to the end of the decade is 400 million pounds, out to 2035, it gets to 1 billion pounds deficit. It's going to be, what does the Fed like to say? Higher rates for longer. We'll debate rates all day long. It's uranium prices, higher uranium prices for longer, but the end user can tolerate it. And I think that's the biggest takeaway.
Yeah, super important detail. Look, I want to thank you for coming on my stage today, Amir. Get in front of this crowd. Let's give him a round of applause.